Welcome back to Investing Talk Podcast.
Today we're looking at Reviva Pharmaceuticals.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And with Reviva, it's a really interesting story.
How so?
Because you're essentially looking at two completely different companies under one roof. I mean, on the one hand, you have this stable commercial business that's actually generating revenue.
Okay, a solid foundation.
Right. And on the other side, you have the big swing, a high-risk, high-reward potential blockbuster drug for the central nervous system.
That duality is really the whole thesis here.
Exactly. So let's start with that foundation, the commercial case. It's built around their product, Vivi.
And Vivi is what exactly?
It's a recombinant human hyaluronidase. But, you know, the important part isn't the science, it's the performance.
Yeah.
This is what provides some stability that most R&D stage biotechs just don't have.
So how is it performing? Is it actually gaining ground?
It really is. We're seeing real signs of traction now. In the first quarter of 2025, they pulled in $1.87 million in revenue.
Okay, that's a real number.
And more importantly, it was a 17% sequential surge, quarter over quarter.
17%? Wow. So that's not just flat growth, that's an acceleration.
It's an inflection point.
Yeah.
It tells you their commercial strategy is finally clicking.
But are they actually making money on it? I mean, revenue's one thing, but profitability is another.
They are. And this is where it gets interesting from an operations standpoint. Their gross margin, it expanded in a big way.
How big?
It hit 74.6% in Q1.
74%. How do they manage that?
Just optimizing their manufacturing. It's driven their cost per unit way down. So it's not just a product that brings in cash, it's becoming a high-margin cash generator.
And that kind of efficiency that flows right down to the balance sheet. Looking at their financials from Q1, they had, what, about $44.6 million in cash?
A very substantial war chest for a company at this stage. It buys them time.
Yeah.
And leverage.
And the part that really stands out to me is the debt column.
Yeah.
It's zero long-term debt.
A clean capital structure, which is a huge strategic advantage.
Yeah.
It means every dollar they get is going into R&D or expansion, not just paying off old loans.
You can see that discipline in the numbers, too. The losses are narrowing.
They are. Net loss was down to about $9 million in Q1 2025 from over $10.6 million the year before.
And the cash burn, that's the real metric for survival, isn't it?
Right. The free cash flow burn, it declined 22% year over year. And management has actually put a date on it. They're targeting FCF break-even.
When?
By the fourth quarter of 2026.
So that gives investors a pretty clear line of sight to self-sustainability. It kind of de-risks the whole long-term picture, whatever happens with the pipeline.
And that stability, it's not just luck. It's built on a pretty significant technological moat. This isn't just about one drug, it's about their platforms.
Okay, let's talk about that. What's the tech protecting them?
They have 3 proprietary platforms, all IP protected: pharmacoengineering, dimeric targeting, and conjugated delivery.
And the IP protection on those is solid.
It extends out to 2035 and even beyond. So they have a very long runway to innovate.
That kind of protection lets them diversify. Which brings us to the pipeline, because the real upside isn't just Vivi, it's about what comes next.
Exactly. That conjugated delivery platform, for instance, is what's behind RVX-212.
And that's their dermatology asset, right? For plaque psoriasis.
Yep. Targeting a market that's, roughly $1 billion. And the big differentiator here, thanks to the tech, is that it's a topical application.
Which is a huge deal for patients. No one wants systemic drugs if they can avoid them. Fewer side effects.
And the early data backs it up. It showed 94% tissue retention.
94%.
Yeah. It means the drug sticks right where you put it on the skin. It maximizes the local effect and minimizes it getting into the rest of your body.
That's a massive selling point. And it looks like the FDA agrees.
They do. RVX-212 got fast-track designation.
Which is basically the FDA saying, hey, this looks important, let's speed up the review.
It's a huge validation. And now we're even hearing some whispers about potential licensing talks.
With who?
The name being floated is Leo Pharma, a major player. And a deal like that would mean non-dilutive capital.
Money without selling more shares, that would completely change their cash situation overnight.
And that's not the only thing in the pipeline. We also have to watch RVX-208.
That's the NASH drug.
Right, for non-alcoholic steatohepatitis. It's in phase 2B, and the data readout is expected around August of 2025. That's another major catalyst.
And we get new numbers even sooner. Q2 earnings are on August 12th.
Yep. Consensus for revenue is about $2.14 million, so We'll see if that Vivi acceleration is continuing. Plus, they're presenting the Nash A data in September.
Okay, so just to recap the first half of this story, you've got a stable commercial base, narrowing losses, no debt, and a couple of really promising mid-stage assets.
A really compelling foundation.
But now we have to talk about the main event. The reason this stock is on anyone's radar, the high-risk, high-reward bet. Brilaroxazine.
This is the home run swing. Brilaroxazine, or RP-5303. It's a late-stage serotonin dopamine modulator for schizophrenia.
This was Reviva's original focus, right?
It was. And if it works, the market is just enormous.
That's a tough market, full of legacy drugs with pretty serious side effects. The clinical data has to be, exceptional to break in.
And their data package is very, very strong, especially on long-term use. They have positive 1-year open-label extension data.
And what does that show?
Sustained efficacy across all symptoms, even the really hard-to-treat negative symptoms.
Things like lack of motivation, emotional flatness.
Exactly. The things that often keep people from functioning in society. Most antipsychotics are not great at treating those.
And the other half of that coin is always safety.
And that's their other big differentiator, the metabolic profile. A lot of older drugs cause massive weight gain, cholesterol issues.
Yeah.
The 1-year data for brilaroxazine shows a really favorable metabolic and safety profile.
And does that actually translate to patients staying on the drug?
It seems to. The discontinuation rate over a full year was only 35%.
35% might sound high to some people, but for this patient population...
It's an exceptional result.
Yeah?
Adherence is notoriously poor because of side effects. So this is a huge potential advantage.
That safety profile is the key. So the timing. What's the next big hurdle?
The big one is coming up fast. The pre-NDA meeting with the FDA. It's targeted for Q4 of 2025.
And that's the make or break meeting, isn't it? Where they ask the FDA, do we have enough to file?
It's the go-no-go moment. A positive outcome there de-risks the whole thesis almost instantly.
And if that goes well?
Then the NDA submission is targeted for Q2 2026.
Yeah.
So the whole timeline for this massive inflection is within the next, 12 to 18 months.
And they're expanding the IP beyond just schizophrenia, too.
That's right. They got orphan drug designation for idiopathic pulmonary fibrosis, or IPF.
Why is that so important?
2 reasons. First, it's another high-value market. But second, that designation gives them a potential 7 years of market exclusivity in the U.S. for IPF.
An extra layer of protection.
A powerful one.
Okay, so strong fundamentals, great data, clear timeline. How is the market pricing all this in? What do the charts and the ownership look like?
Well, the price action has been extremely volatile, as you'd expect. The stock is trading much closer to its floor, around 25 cents, than its highs near $3.
But there are signs of a shift, aren't there?
There are. We saw a golden cross back in January of 2025.
The 50-day moving average crossing above the 200-day?
For people who track that stuff, it suggests a major shift in momentum, the beginning of a potential uptrend.
And who's driving that? Is it just retail speculation?
It seems to be the smart money. Institutional ownership is very high for a company this small. It fluctuates, but it's been north of 60% at times.
We've seen some big names coming in.
We have D.E. Shaw, Crescendo Capital. These are firms that initiated big positions. They're not playing for a 10% gain. They're betting on a major event.
And it's not just outsiders. Insiders were buying too.
Yep, over 86,000 shares bought by executives earlier in the year. That shows they believe it's undervalued.
Which all points to this valuation gap that the analysts are seeing. What's the Wall Street consensus?
The discount is dramatic. Analyst price targets range from around $3.33 up to $7.
$7.
That's from Jefferies. They're citing that differentiated clinical profile.
So you're talking about a potential 4 to 5 times upside from where it's trading now. Why is there such a big disconnect?
Risk. Pure and simple. The stock is trading at only 2.9 times 2025 estimated revenue. Peers trade closer to 4.8 times.
So the market is pricing in a high chance of failure.
A very high chance. It's saying, we don't believe you'll execute on the brilaroxazine timeline.
Which means we have to talk about that risk. Let's get into the bear case. What could go wrong here?
The biggest, most immediate risk is financing and dilution. Cash is always finite. They just did a $9 million equity offering.
And the market never likes those.
Never. The stock plunged 39% pre-market when they announced it. And even with the cash they have now, they're almost certainly going to need more to launch brilaroxazine.
So more dilution is basically a certainty.
It's being priced in as we speak.
Okay. What's risk number 2?
Nasdaq compliance. This is one that always spooks investors.
The $1 minimum bid price.
Exactly. They have until November 10th, 2025 to get back over $1.
Yeah.
If they don't, they might have to do a reverse stock split.
Which, while it doesn't change the company's value, is almost always seen as a negative by the market.
It just crushes sentiment.
And the final risk, the biggest one of all.
It's just execution. The entire thesis hangs on them navigating that regulatory path perfectly. That Q4 pre-NDA meeting is everything.
Yeah.
Any kind of setback, any request from the FDA for more data,
It would be devastating.
they would wipe out the entire CNS upside story pretty much instantly.
So when you blend it all together, the solid base, the massive upside, but also these really significant risks, what's the final picture?
It's a classic asymmetric bet. The potential reward is massive, driven by a potential blockbuster with a better safety profile. But the valuation is being held down by very real, very immediate fears about dilution and compliance.
But the catalysts are all on the calendar. This isn't a wait-and-see story forever. We have the Q4 FDA meeting, the Q2 2026 submission target. It's a high-volatility play that demands patience.
It does. And I guess the final thought I'd leave you with is this. The current price reflects the fear of the next capital raise, which is basically a sure thing. But the institutional money seems to be betting that the pain of that dilution is a small price to pay for the chance at a 4- or 5-fold return if brilaroxazine succeeds.
Remember to subscribe to Investing Talk podcast for all our latest company breakdowns.